the climate credibility gap in big oil's green messaging. For over 2 decades, the world's biggest oil and gas firms have repositioned themselves from climate change skeptics to supposed climate allies. Through high budget advertising and polished corporate communications, companies like BP, Chevron, Shell, and ExxonMobil have portrayed themselves as forward thinking actors in the energy transition, investing in renewables, lowering emissions, and backing future technologies. But a closer look at their actual investments, operational decisions, and energy output tells a different story. While the branding has shifted, the fundamentals of fossil fuel dominance haven't. For decision makers in business and policy, the gap between messaging and measurable impact is worse than a poor public relations issue. It is a material risk. Climate messaging versus investment reality. Many oil and gas companies emphasize their climate credentials in campaigns that highlight emissions reductions and low carbon technologies. These stories often focus on emissions from company operations, which are just a small portion of their overall climate impact. The bulk of emissions from end use combustion go largely unaddressed. Ads promoting wind, solar, and biofuels investment suggest a pivot to clean energy, yet the share of total capital expenditures going toward renewables remains minor. Recent pullbacks from solar and offshore wind further reinforce that fossil fuels continue to dominate both output and revenue. For B2B audiences, this discrepancy affects everything from risk profiling to strategic planning. Whether it's a supplier, partner, or portfolio company, trust in climate alignment depends on whether long-term investments match public commitments. Bridge fuels, future tech, and the delay tactic. Corporate messaging has also leaned heavily on bridge solutions, technologies that maintain fossil fuel use while appearing climate aligned. Natural gas, for instance, has been framed as a cleaner option and a partner to renewables, despite growing evidence that methane leaks and rising demand are eroding those benefits. Carbon capture and storage, CCS, is another centerpiece of these campaigns. Though marketed as a scalable solution, most CCS projects today operate at small scale and are often linked to enhanced oil recovery, effectively prolonging fossil fuel use rather than replacing it. Looking further ahead, clean hydrogen and algae biofuels have featured prominently in marketing. In practice, hydrogen remains largely fossil-based and commercially limited, while algae fuel programs have been quietly abandoned after years of promotional hype. These forward-looking narratives aren't harmless. They help defer more aggressive policy, shift responsibility to consumers, and delay serious low-carbon transitions. For stakeholders evaluating energy partnerships or sustainability claims, the key is separating technical promise from present-day readiness.